China's economy has been one of the most talked about in the world. For decades, it has been seen as an unstoppable force, a country whose rapid industrialization and booming cities represented the future of global growth. But recently, cracks have started to show in this powerful economic engine. Some experts even believe that China could be heading toward an economic collapse. But why? And what does that mean for the rest of the world? Let's dive deeper into the issues facing China's economy, what's causing these problems, and how this could affect your personal finances. First, let's explore one of the most significant contributors to China's economic challenges, its real estate bubble. To fully understand this, we need to look back at how China's rapid urbanization began. Over the last few decades, China's population moved en masse from rural areas to cities. This created an enormous demand for housing. In response, developers started building and building and building. Real estate became the backbone of China's economy. Today, real estate investment accounts for about 30% of China's total GDP. That's enormous. For comparison, in the US, real estate typically accounts for less than 20% of GDP. However, there's a problem. China built too much too fast. Massive apartment complexes, luxury condos, office buildings, many of them were built, but no one moved in. These ghost cities are a striking image of overconstruction. Entire neighborhoods sit empty, with thousands of apartments left unsold. Developers borrowed heavily to fund these projects, relying on future sales to pay off their debts. But when the market began to slow, many of these companies found themselves unable to sell enough properties to cover their massive loans. Take Evergrande, for example. Once a symbol of China's real estate success, Evergrande became the poster child for the country's property crisis. The company accumulated over $300 billion in debt, making it one of the most indebted companies in the world. When Evergrande began to default on its loans, it sent shockwaves through China's financial markets. Thousands of homebuyers, investors, and contractors were left in limbo. And Evergrande isn't alone. Other real estate giants like Country Garden and Sunac have also found themselves in financial trouble. This real estate crisis is having a ripple effect on the entire economy, but real estate is only one piece of the puzzle. Let's talk about China's broader debt problem. Over the last 2 decades, China has relied heavily on debt to fuel its economic growth. Local governments in particular have borrowed extensively to fund massive infrastructure projects, everything from highways to high-speed rail. This has led to impressive growth in the short term, but now many of these local governments are drowning in debt. Some estimates suggest that China's total debt, including government, corporate, and household debt, exceeds 300% of its GDP. That's an incredibly high level of debt, and it's unsustainable in the long run. In addition to the real estate bubble and rising debt levels, China is also grappling with another serious problem: unemployment. Specifically, youth unemployment is skyrocketing. In recent months, the unemployment rate among young people in China's cities has reached over 20%. That's 1 in 5 young people without a job. This is a big deal because young people are supposed to be the engine of economic growth. They're the ones who enter the workforce, start spending, buy homes, and start families. But with unemployment so high, many young Chinese are unable to contribute to the economy in the way previous generations did. They're delaying major life decisions like buying homes and starting families, which only further slows economic growth. This youth unemployment crisis is also tied to a larger demographic problem facing China. For decades, China's one-child policy kept population growth in check, but now it's coming back to haunt them. China's population is aging rapidly, and there aren't enough young workers to replace the aging workforce. By 2050, it's estimated that 30% of China's population will be over the age of 60. Fewer workers mean lower productivity, and that's a huge concern for any economy. In fact, in 2023, China experienced its first population decline in decades, and this trend is expected to continue. So why does any of this matter to you? Well, China isn't just another country, it's the world's second largest economy. It's deeply intertwined with global trade and financial markets. If China's economy falters, it will have a ripple effect across the globe. You might start to see the impact in the prices of everyday goods. Think about how much of what you buy, whether it's electronics, clothing, or even furniture, comes from China. If China's factories slow down or close, the supply chain disruptions could lead to shortages and higher prices worldwide. And then there's the stock market. Investors around the world have exposure to Chinese companies, either directly or through global indexes. If China's economic problems worsen, global markets could see significant volatility. We've already seen some of this in the wake of the Evergrande crisis, where global markets reacted to the uncertainty in China's property sector. And as China's debt continues to rise, the risk of a financial crisis grows. A major financial crisis in China could trigger a global recession, affecting jobs, investments, and economies everywhere. So what can you do to protect yourself? First and foremost, it's important to stay informed. Keeping an eye on global events, like China's economic situation, will help you make better financial decisions. If you're investing, consider diversifying your portfolio. This means not putting all your money into one market or sector. Spread your investments across different asset classes, including stocks, bonds, real estate, and even commodities. Diversification can help reduce your risk if one part of the market takes a hit. Next, be mindful of inflation. If China's supply chains get disrupted, the cost of goods could rise globally. This means higher prices for everything from electronics to everyday household items. Make sure you're prepared for potential price hikes by maintaining a strong personal budget. Try to avoid unnecessary debt and, if possible, build an emergency fund to cover any unexpected expenses. Another thing to watch is interest rates. As China's economy slows, it could have an impact on global interest rates. If central banks around the world react to China's slowdown by cutting rates, it could make borrowing cheaper, but it could also lower returns on savings and bonds. It's important to be aware of how these changes could affect your financial situation, whether you're borrowing money for a mortgage, saving for retirement, or investing in the stock market. The road ahead for China's economy is uncertain. Some experts believe that the country could experience a hard landing, a sudden and severe economic downturn, while others think that China might be able to manage a slower, more controlled decline. Either way, it's clear that the days of double-digit growth are over, and the challenges China faces will have global implications. In the end, no one can predict exactly how things will unfold, but by staying informed, staying diversified, and making smart financial choices, you can better prepare for whatever the future holds. Remember, financial security isn't just about reacting to crises. It's about planning ahead, staying flexible, and being ready for whatever comes next. If you found this video helpful, make sure to hit that like button, subscribe to the channel, and ring the notification bell so you don't miss our future updates.